As we head into the new trading week, the U.S. stock market is currently closed for the weekend. The last session for Bigbear.ai, ticker BBAI, concluded on Friday, November 14th, 2025, with the stock finishing the day at 6.06 USD. This was a decline of 4.42% or 28 cents during the regular session. However, in after-hours trading, it did see a flicker of buying interest, ticking up 1.65% to 6.16 USD, setting a tense stage for Monday's open. Now, many investors looking at that 4.42% drop might assume it's just another volatile day for a small-cap AI company, perhaps giving back gains from earlier in the week. But the reality of what is happening under the surface at Bigbear.ai is far more complex and just had a massive new variable thrown into the equation. The drop last Friday wasn't random noise. It was the market struggling to digest one of the biggest, most contradictory news events in the company's history. Just a few days prior, on November 11th, BBAI reported its third quarter earnings. On the surface, the headline was a clear positive. The company posted a loss of only 3 cents per share, which was a significant beat over analyst expectations for a 7-cent loss. Revenue also came in at $33.1 million, narrowly beating the $31.8 million consensus. This news, as you'd expect, sent the stock soaring in the pre-market, jumping over 20% to nearly $6.80 a share. But here's the tension, the part the market is now grappling with. That $33.1 million in revenue, while a beat, was actually a 20% decline from the same period last year. The company's gross margin also compressed, falling to 22.4% from 25.9% a year ago. This is the central conflict for BBAI. How can a company be celebrated for beating estimates when its actual top-line business is contracting? The answer lies in the second piece of news that dropped simultaneously, an announcement that completely reframes the company's future. Bigbear.ai announced it is acquiring Ask Sage, a generative AI platform focused on defense and national security, for $250 million. This is not a small tuck-in acquisition. This is a massive, high-stakes bet. Ask Sage is projected to bring in about $25 million in annual recurring revenue this year, meaning BBAI is paying a steep 10 times forward ARR. This move is a clear signal from management, led by CEO Kevin McAllianan, that the company's existing path wasn't enough. They are aggressively buying their way into the secure generative AI space, a field they believe is the future of government and defense contracting. The market's expectation was for a simple earnings report, a small beat or a miss. The reality is that BBAI is attempting a dramatic strategic pivot while its legacy business is showing signs of weakness, specifically due to reduced work on certain U.S. Army programs. The stock's volatile action, surging to 680 and then bleeding back down to 606, reflects this profound uncertainty. Is this a brilliant forward-looking move, or a desperate, overpriced acquisition? Many retail investors, particularly on forums like Reddit and X, have long been conditioned to view stocks like BBAI through the lens of short squeezes. The narrative often becomes about us versus them, a fight against hedge funds. The expectation is that any AI-related stock with a small float must be the target of massive bearish bets. However, a look at the actual data reveals a completely different reality. This is not a stock under siege by short sellers right now. Recent data on borrowing costs shows that the fee to borrow BBAI shares is incredibly low, sitting at an annualized rate of just over 0.5%. Furthermore, there are millions of shares available to borrow. This is not the sign of a high-conviction short attack. It's not the high-fee, low-availability environment you see in a true short squeeze candidate. What does this mean for you? It means that looking for a squeeze is likely focusing on the wrong story. The institutional play here is far more nuanced. While some funds, like Citadel, did trim their positions recently, the largest holders are moving in the opposite direction. Vanguard significantly increased its stake by over 32%, now holding 27.6 million shares. BlackRock also raised its position by nearly 18%, holding 23.7 million shares. These massive institutions are not betting on a squeeze. They're making a long-term calculation on whether this $250 million acquisition of Ask Sage, combined with the company's existing $380 million backlog, can successfully capture a piece of the massive new defense and intelligence budgets being allocated to artificial intelligence. Understanding this distinction is critical for any investor. When you look for short-selling data, you can check platforms like Fintel or S3 Partners, which track short interest and, more importantly, the cost to borrow. A high cost to borrow, say in the double or triple digits, is your signal of high demand from short sellers. A low fee, like BBAI's, tells you the shorts are not, at this moment, piled into the name. What's your take on this? Do you think the low borrow fee means the smart money isn't bearish, or that they simply haven't noticed the revenue decline yet? Comment below. The risk here is not a coordinated short attack. The risk is execution. The company is now tasked with integrating a massive acquisition, reversing its revenue decline, and converting its huge backlog into actual profitable sales, all while navigating the lumpy and unpredictable world of government contracts. So what exactly does Bigbear.ai do that puts them in this position? At its core, the company provides AI-powered decision intelligence. It builds systems that take vast, complex data sets and provide clear, actionable insights for high-stakes environments. Its clients are almost exclusively in the public sector: defense, national security, and logistics. Think of it as a direct, albeit much smaller, competitor to a giant like Palantir. They build the operating systems for missions. For example, their biometric Veriscan platform is used at airports for passenger processing, and their Conductor OS is designed for autonomous systems within the Department of Defense. This focus on secure, mission-critical AI is what makes the Ask Sage acquisition so interesting. Ask Sage is built specifically to allow for a secure deployment of generative AI models in these highly regulated, air-gapped environments where data cannot touch the open internet. The bet is that while the commercial world plays with open models, the entire U.S. government and its allies will need a secure, verified platform. BBAI just bought what it hopes will become that platform. This move has earned them some support from analysts. Cantor Fitzgerald, for instance, just reiterated their overweight rating and raised their price target from $6 to $7. Their thesis is that this acquisition, while expensive, accelerates the company's strategic roadmap and positions them perfectly for the long-term secular tailwinds of government AI adoption. They see the 20% revenue dip as a temporary disruption related to specific Army contracts, not a permanent impairment of the business. The expectation from this bull case is that as the U.S. and its allies approve new massive defense budgets, with some proposals topping $1 trillion and earmarking billions specifically for AI and autonomy, BBAI will be a prime beneficiary. Its $380 million backlog is seen as proof of demand just waiting to be converted. However, the opposing view, the reality of the risk, is just as compelling. The company is not profitable, its gross margins are shrinking, and it just spent $250 million on a company with $25 million in revenue. That's a huge outlay that puts immense pressure on management to execute flawlessly. If the integration of Ask Sage is fumbled, if the expected revenue synergies don't materialize, or if the core business continues to see disruptions from its Army clients, the company's cash position will be strained. This is the central gamble. The market is weighing the massive, long-term potential of becoming the go-to secure AI provider for the Western world against the very real near-term risk of a costly acquisition and a contracting core business. The stock swing from 680 back to 606 shows that the jury is out. Looking ahead to this week, the option chain provides some clues. We see significant open interest in the coming expirations, particularly for the November 21st and December 19th monthly contracts. The put-call ratio is not screaming extreme fear, but it's not wildly bullish either. It's neutral, reflecting the market's wait-and-see attitude. The $7 strike price for calls has a lot of open interest, representing the level bulls need to break through, which lines up perfectly with Cantor's new price target. The $5 strike on the put side shows where investors are placing their downside protection. The max pain level, the price at which the most option contracts would expire worthless, is hovering around the 6 to 6.5 mark, suggesting the stock might stay pinned in this range as the market waits for the next catalyst. That catalyst could be news of a new large contract win, an update on the Ask Sage integration, or further filings from large institutions. For investors trying to navigate this, the key is to ignore the meme stock noise and focus on the fundamentals of this pivot. The expectation was that BBAI was a simple, slow-moving government contractor. The reality is that it has just transformed itself into a high-growth, high-risk generative AI play. The old models for valuing this company are arguably out the window. The new question is simple. Will the $250 million purchase of Ask Sage be the key to unlock the $380 million backlog and capture billions in